Let's begin with one of the key themes. It's this decoupling theme that's back on the table. Walk me through some of the results.
Yeah, good morning. So I think one of the biggest result this month, I think, is the big increase in allocation to the US. The US has been an underweight now for over a year and a half, and over the last few months people have been reducing that underweight. For the first time this month, the US moves to a small overweight. People are taking money out of Europe and out of emerging markets to do that. And we think that makes sense because I think the US is the region where growth looks strongest right now, and risks look bigger in some of these other regions too.
So Ronan, just looking at some of the crowded trades out there to go along with this, to what extent will this just sort of exacerbate some of the crowded trades that already exist?
Yeah, you're right. I think the crowded trade that people fear most right now is the FANG and BAT stocks, so the big tech mega caps in the US and in emerging markets, and obviously the US ones are the biggest of those. So to some extent there is a correlation there. We certainly think that technology overall can retain leadership in the market in our recommendations, but we would recommend diversifying away from the FANG mega caps. I think it makes sense to diversify into broader tech because these FANG stocks are very, very, very well owned at this stage.
Ronan, to your point, very well owned, and it's a buy-side report, which means the money's already getting put to work. And I just wonder, from your perspective at Bank of America, Merrill Lynch, just walk me through the case to actually be heavily invested in the United States and to fund that exposure by reducing your exposure to emerging markets and to Europe too.
Yeah, look, I think what the environment we're in right now is what we would characterize as late cycle. We see some deterioration in macroeconomic data around the world over recent months. That's reflected in some of the quantitative models that we run at Bank of America as well. And in that environment, it makes sense to increase the quality of your portfolio and be slightly more defensive. And from a regional perspective, that favors the US. So that's the main reason we would favor the US right here. I think as well, if you look at some of the risks to the outlook, apart from just the fact that growth is slowing in some regions, you have worries about trade wars, you've got high oil prices, and these are things that are much more of a problem for Europe and the emerging markets than in the US. Also, politics is a risk, as we see recently in Europe. So I think the US just looks like a better risk reward right now. Given the correction we've seen in the US market over the last few months, the valuation of US equities has come down a little bit. And, albeit the allocation to the US is rising, it's still been out of favor for the last year, 18 months. And so I think the US overall has a better risk reward for us.
So, Ronan, can you reconcile where you think we are in the cycle with the cash allocation that seems to come out of this survey?
Well, it's interesting because growth expectations in the survey have really deteriorated. There's now as many people that expect the economy to deteriorate over the next year as there are that expect it to improve. So growth expectations look fairly cautious, and that actually coincides with a cash allocation that's above average. Now, we don't see a cash allocation that's consistent with recession, so it could definitely get worse. But I think a slightly cautious cash allocation is consistent with lower growth expectations, lower profit expectations globally than was the case certainly coming into this year.
Ronan, just to wrap things up with you, I think it's always interesting to get an idea of where the bias is, where the consensus is on certain topics. And an important topic is, at what point does the drift higher in Treasury yields start to bite into risk appetite more broadly, and perhaps for the equity market more specifically? What came out of your survey? We're close to 3%. Is that anywhere near where investors that you survey start to get worried?
Yeah, we have asked that question, and if you look at the weighted average response, 3.6% is the danger level. So obviously a range of responses around that, but that's where the average comes out. So most investors think that bond yields can rise a little bit more before that in itself is a problem for equities.